Hello, hey everybody. Thank you all very much for coming. It's great to see a lot of you names that I know and a lot of names that I don't know. So it's really exciting. I appreciate it, especially on such a busy day and across the world. See, Zena from Australia is in there, so I know it's got to be early over there. So today, what we're going to talk about is Market Gamma 101. And I should first make sure everyone can hear me. If you could just type a little something in the chat. Somebody, I'm turning in one of those old men that doesn't know how to use technology anymore. Hey Madoon, how you doing, buddy? I've made the mistake many times here of talking for like an hour and no one can hear me. So pardon my old man ways here. All right. So today what we're going to do is we're going to talk about Market Gamma 101, not Options Gamma 101. My assumption is here that you have a basic understanding of Options Gamma. And so I'm going to talk about Market Gamma, which is what I call the dealer or market maker position. And I want to also clear one thing up. I'm going to use the words market maker and dealer interchangeably. I understand that they're technically two different entities. Some people call me on that. A market maker is someone who makes markets on an exchange, and a dealer is usually somebody up at a bank who makes markets, or is more like a broker. But I'm going to use those interchangeably as I think their position is more or less the same. So we're going to talk about Market Gamma 101. I got a slide on vanna. I know that's a big one everyone wants to talk about. I'm going to talk about the market today for a little bit, what I thought happened and kind of what my view of that was. And then we could take some questions. So if that works for everybody, well, you don't have a choice. That's what we're going to do. All right. So Market Gamma 101. And again, those of you who have been following the concept of gamma for a while, this is going to be familiar to you. But stay with me here. So, all right, let's just talk about gamma very quickly. When a trader buys an option, that means a customer, meaning, I'm sitting here in front of my Robinhood account or whatever I may be using, or I'm a big hedge fund, and I buy 100 contracts. Let's say I buy some puts. Those puts have an option delta of 50. So what that means is that for every dollar that the underlying stock moves, the underlying option is going to change 50 cents, right? So the market maker is now short 100 puts, right? Because the customers on their side, they bought 100 puts, and the dealer needs to initiate a hedge immediately because he doesn't want to have directional risk. That's called a delta hedge. And that's going to play into what I want to talk about today. So I just want to make sure we cover that basic basis. So that's great, right? Now, if someone bought calls and the dealers were then short calls, they would then buy stock, right? They would take the other side of that. So, for those of you who aren't familiar with this topic, you can look it up. There's a lot of good videos online that kind of explain this, but I just want to get this basis down. Okay, so what happens as the stock moves around? Obviously, if the stock goes up, those puts are going to change in value, right? And so the dealer's got to buy back short shares. What happened today when the market went from 38.50 up to 3900? VIX collapsed, implied volatility dropped like a rock, and the market just ripped, right? Well, anyone who bought puts yesterday or today had to cover those puts like wildfire, right? So that's the cover of the delta hedge when someone closes their position. But as the market was dropping this morning, dealers had to short shares to protect against their short put position, right? That's the gamma hedge. So every day when the stocks move and adjust, the S&P goes up and down, dealers need to adjust their hedges, and that's the gamma hedge component, right? And that's what we often measure, and I'll talk about why that is. And then obviously this last bar, I skipped ahead a little bit, but when the trader closes his position, or when a lot of options expire, i.e. last Friday, dealers need to buy back their short hedges. So just to give an example, on Friday this past Friday was the March options expiration. The quarterly expiration is always a big one. And there was just a ton of QQQ puts out there, lots. And I said in our subscriber note on Friday, I thought maybe that they had bought back all their hedges, but man, was I not 100% right on that call, because Monday we had just a ripper, and it was clear that that was short covering, and that was the what I like to call exhaust from the options expiration, right? Because all these puts are gone. All the dealers and market makers who were short puts suddenly had no option position, and they had to cover that back, right? So that's the delta hedge covering. And we're going to tie all that in together here in the next few steps. So let's just visualize that real quick, right? This also ties into a gamma squeeze. A lot of people like to ask what the setups are for a gamma squeeze. And that maybe we could talk about in the Q&A after. But essentially what we're doing here, right, is when a trader buys a large call option position, like right here, the market makers on the other side of that position, they need to hedge, right? This is where the hedge would take place. And then as the stock goes higher, the market maker needs to chase that position. They have to keep buying more shares. Now, this is if the market maker is in a negative gamma or a short gamma position. We're going to talk about that. But this is essentially what causes the gamma squeeze, right? If I'm short a call, if I'm a market maker, I'm short a call, I gotta buy stock to keep myself hedged, right? You think about like, why does GameStop, why did that go up 1,000%, in a day, and why can the market just pump, drop so quick and then revert back, and things are just flinging everywhere. When a market maker needs to hedge, they're price insensitive, right? They're not like you or me who's trying to maybe scalp some futures or something. Like, they have a hedge, they got to buy that hedge right away, right? And if they don't need the hedge anymore, they close it out. And that activity, really fast trading, is often, I think, a sign of hedges being bought and closed. So the same side, right? On the other side, if a put option comes in and traders buy a lot of puts, the dealers short those puts and they need to short stock, right? And as the stock goes lower, they will need to sell shares. And now what happens here is the stock turns up, they're going to have to cover those short shares, right? Because if I'm short a put and the market goes up, that's awesome. But if I'm short 1,000 shares, against 100 put options, those short shares are going to lose money, right? So I got to buy those shares back quite quickly. So you can see how this can create momentum trades. You need to picture this one example. It happens to be GameStop. Magnify that across the entirety of the market, right? Think about everybody buying calls at the same time, or everybody buying puts at the same time, and you can see how these big flows could affect the market, right, or could affect an individual stock. All right, so let's break this down a little bit. I want to talk about dealer gamma. You know what happens on an individual basis, but let's talk about the market in general. So this is we produce this chart for our subscribers every day. This is called the SPX, estimated gamma. And the only chart line I want you all to pay attention to is this black line. This is today's estimated gamma. So this is a positive gamma in green, and positive gamma means when that dealers are long call options. We estimate that when we're in this green zone, dealers are long calls, they have a positive gamma position, and that means when they're hedging, they are trading against the market. So what do I mean by that? If they're long a call, they're going to short a little bit of stock, right? And as the market goes up, their call options making more money, so they sell some more futures to hedge themselves out, right? So as the price of the S&P 100 goes up, as gamma goes higher, as you can follow this black line here, up means more gamma. As the price goes to the right, here along the x-axis, dealers are going to short more futures, right? And then when the market comes down, they're making a bunch of money on that short hedge. They're going to start to buy it back, right? Because their long calls are losing a little bit of money, but their short hedges are making money, and they want to balance that out. So it's a game of ping pong, right? If they're up here, they're going to sell here, they're going to buy back. We're going to show a chart in a minute, but what happened over the last however many days, even today, you could argue, right? 3950 to 3900. We ping ponged off that level. I can't even count how many times now in the last couple of weeks. What is the net effect of this? Sorry about that. What I want you all to take away from this is that the higher and the more positive gamma there is, the tighter the trading range is, the lower volatility is. And so depending on how you trade, I would actually argue, sort of regardless of how you trade, you want to know that information, right? How much volatility is in the market. If I'm scalping, do I want to look for a 50-point move, like maybe today because we had a negative gamma position, which I'll shed light on? Or is it like very positive gamma where I could expect, okay, maybe 10 handles, or 2 points in spiders is what I can get. So that's why that matters, right? Knowing that how much gamma there is in the market, and we have some data to back this up too. Now let's talk about negative gamma. This morning, actually at the close last night, we flipped over this. There's a red line here, which is hard to see, and that's what we call the gamma flip point. And that just means that gamma shifts the estimated dealer gamma position. The way that they're going to hedge is no longer a positive gamma position, but it's a negative gamma position. You can see it goes below 0 here. So what does that mean? Well, when we get to a negative gamma position, dealers are short generally put options. So as you all know, if you're short a put and the market goes down, that's bad. No bueno, right? So you got to short stock, short futures to hedge that position. And as the market goes lower, you got to short more. And you keep on shorting, right? And then what happens when the market bounces and comes back up? Well, you got to buy back. So instead of trading against the market like they're doing here in the positive gamma scenario, they're trading with the market. They're pushing the market in whatever direction the market happens to be going in. So again, short stock as it goes lower, they're buying stock when the market rises. The mechanics work the same in single stock. The key with single stock is you got to figure out how are most people positioned. That's what made trading against the Wall Street bets or with the Wall Street bets people and crowd so nice was we knew exactly which way everyone was leaning, right? We knew everyone was long calls in GameStop. We knew everyone was long calls in AMC, and you could play that, quite clearly. And the waters have muddied a little bit recently, right? For a variety of reasons. We can talk about some of those maybe at the end, but the key to this is knowing and estimating sort of, how people are positioned. Now, I would also say one idea here, right? Positive gamma we equate to call options. So you could almost think of the amount of gamma in the market as measuring almost like a put-call ratio. Because in our model, calls for the S&P and the Nasdaq index, calls bring positive gamma, puts bring negative gamma. So in a way, you could see a lot of positive gamma means there's a lot of calls in the market, right? And there's a lot of negative gamma, there's a lot of puts. And so how do you typically trade around those positions? I personally, if I have a call option, I could sit with that call option for a couple days or a couple weeks, and you're not too worried about implied vol. Yeah, you have some decay. If the market moves up or down a little bit, it's not too big of a deal, right? The sensitivity of that option to changes in volatility is obviously nowhere near the same as a put. Today, if you had a long put at 38.50 and the market bounced, just say 5 handles, say 38.50 to 38.55, that put probably got crushed, right? The thing might have lost 30% of its value, like that, right? So you got to actively trade those puts. Well, what happens when people are adding a bunch of positions and then removing them from the market? That's the delta hedge activity, right? That is creating volatility in the marketplace. So I think anytime you have more puts in the market in general, you're creating more volatility. Whereas calls, people are going to hold those calls at expiration. They're a little, maybe they're against some stock. It's not the same. The mechanics of what people are doing around those trades are not the same. So hopefully conceptually that clicks with some of you guys. So I said we have some data. Let's talk about this. So every day we produce a report for subscribers. You guys are all pretty familiar with this. And we produce something called the SpotGamma index. This just tells you how much gamma is in the market for all these various indices. So you can see QQQ, Nasdaq, spiders, etc. So yesterday there was a small positive gamma, 0.12, and that's a negative 0.22 for today. Now, you can look at it in a notional basis. I just find the notional kind of confusing, so we just call it the SpotGamma index, which is the same thing, right? If the gamma index is negative, dealers are in a negative gamma position. So every single day, we put out this number, and then we have a big historical database that shows us the forward return for a given gamma reading. In other words, we look back in our history and see, okay, what happened on the other days when gamma was around this level? Oh, we typically get a move of 1.2%, right? So knowing that, look at this chart here, the scatter plot. So every single day in history, we plot the gamma index on the x-axis, and then they tell you the one-day forward return. So not what happened yesterday, but what did the market do over the next 24 hours? That's what the y-axis is, right? It's a predictive measure. And you can see that the more positive gamma gets, the tighter the return, the lower the volatility is in the market, right? And as we get to a negative gamma position, the amount of volatility expands greatly. And then what's super interesting is when you get really negative, the volatility calms back down. There's kind of a turning point here, which is off the record or sort of off the scope of what we're talking about here, but it's an interesting note for those of you who've been around for a while. So this is what the sort of the basis of all this gamma talk is, right? Anyone who talks about positive gamma and negative gamma and the volatility in the market, this is really what it boils down to. And on this note, I didn't include this slide. I'm embarrassed I should have, but the gamma in a large way ties to the options expiration cycle, which a lot of you are familiar with. So every third Friday of the month is a large options expiration, and volatility tends to decline into that third Friday expiration like we just had, and then all of the options expire, or a big position or a big percentage of those options expire, and so there's no more hedges that are needed, right? That big gamma position that's often there expires, right, on a Friday night, and then the next day, on Monday, people are going to add new positions. Dealers don't have as much to hedge, or maybe they have some deltas to unwind, and the market really shifts and moves around quite a bit, right? That's the Nasdaq sort of, whatever that was, a 2% rally or 3% rally or whatever they had on Monday afternoon is a good example of that. So this is sort of the antithesis of what you should understand, I guess, with the market gamma. So again, we produce these levels every day in our daily notes, so you can estimate how much gamma there is and what the range is on the day. 47 points is what we marked as the max move from the cash open is typically how we look at that. I didn't catch exactly where the cash open was today. I think it was around 38.80. So, if you had 47 points to that, this number comes in surprisingly close. This range comes in surprisingly close. So if you're trading options on a daily basis or you're scalping or swinging, I love to look at where the outer bounds are of this range, high and low, and look at big options levels, which we'll talk about in a second, that match up with around this outer bounds. And you'll find some really surprising support and resistance lines in there, and then interesting ways to buy or sell options around that. The other thing we show here is the 5-day move. So you can extend this a little bit. I don't like to really look farther than 5 days, but there's a mean reverting property to markets over days and weeks, and we'll show that on a chart in a second. So is gamma predictive? Again, this is the gamma 101 conversation. So let's talk about this, right? This is from the 25th. You can see there's a massive amount of options. So above the y-axis here shows the total call gamma, and then on the bottom is the estimate of the put gamma. So this is SPX, the S&P 500, big options over here, and on the right we have the spiders. So you can see there's just a massive amount of gamma at 3,900 relative to all the other strikes. Big old bar. So somebody asked this morning at the top of the conversation, why do we keep going back to 3,900? Well, if we're unsure of which way the market's going to go, if there's not conviction to go higher or lower, guess we're going to get sucked into these big levels, right? So, let's look at the spiders, right? Where's that big bar? Where was resistance over the last several days? There's a ton of call options posted up here at 395. And there's conversations oftentimes about, well, that's not long, or this positions that someone bought those and sold those ones to be open and blah, blah, blah. Look, options get hedged, and hedging activity, liquidity centers, those draw activity, right? And that's why these are support and resistance zones, because when the market approaches, one step back quick, gamma is highest for options that are at the money. That means the hedging activity is highest when the options get to be at the money. In other words, the highest hedging activity should take place at 3,900 and 395, right? And that doesn't mean we have to stick at these levels. It just means that there's going to be options hedging activity woken up, so to speak, when we get to these big areas and these big levels. So what did the market do? And this is going back to the 10th, right? Here's that large spider open interest, and there's big open interest at 395, not as big, at 3950 in the S&P, in the big S&Ps, right? So don't want to discount that, but here's the chart, right? This is the spiders on the on the left axis, S&P on the right. And this has been a game of, like I said, prices mean revert over several days, as you can see here. This was the March options expiration. And this 3,900 OI did not change, throughout expiration. So we were looking for a volatile breakout, right, this week. That didn't quite manifest, obviously. We certainly had some volatility today, no doubt, right? But we're kind of just back in this box that I keep calling it the box, right? But there's a mean revertive property here. This is, 395 in spiders, 3,950. It rejects, right? Market breaks that. The buying power exhausts, and we get drawn right back down into these big levels. So depending on what your time frame is and your view and how you want to trade, you can see that there's polarity to these zones, right? They're magnets, so to speak, right? It's liquidity, and really great futures traders I've talked to will tell you that if you see big areas of liquidity, the market goes to those liquidity areas. They're like a magnet, right? So if we zoom out just a little bit, I want to talk about one concept, right? We have a proprietary index, a proprietary indicator called a vol trigger. For purposes of this conversation, just think of this as the gamma flip line. So we talked about in this chart, this line right here when gamma flips from positive to negative, and you can sense when that goes from maybe not so much volatility in the market to a lot of volatility. So this shows you in the blue is the S&P 500 index, and the orange line, I was going to say gold, it's kind of more orange, shows you what happens if you are long the S&P, so just call it, you own spiders, only when the market is above this vol trigger level. So again, the zero gamma line, whatever you want to call it. So every day we put out this number. So in today was 38.90 was the level. So if the S&P is over 38.90, you buy spiders and you just hold them. Don't do anything. And then if the market crosses that line, you go flat to cash. What happens? You can see that right now there's a little dislocation in price, but you can see that over time, the two perform very closely. And this isn't a big bull market. But the major drawdowns that we've had in the market, the ones where you're in the middle of it, right? In the middle of March this year, in the middle of December of 2018, and you are scared, right? Because your position has lost a lot of money, right? Your 401ks and you're thinking, holy cow, what's going on in the market? This is, when you own spiders here, is a positive gamma position. And when you go and sell cash, go to cash, this is a negative gamma position, right? And this isn't shorting or trying to buy the dip, right? This is simply just going to cash. You can see that you avoid these huge periods of volatility. Now, if you're a great trader and you have a great dip buying strategy or you want to short stock, there's all sorts of ways you can augment this return, right? Improve the return of the orange line. But if you just follow this basis, the data is there to support, man, I would sleep way better at night all in cash, and then I figure out, of course I would buy this dip right here, right? But kidding, obviously. So, the point is that this is just when you zoom out, right? We get lost in the day-to-day. When you just take a step back and say, what is this information giving us? What is this telling us on a bigger picture? It's quite powerful, right? And it's explaining what's happening in the market. People are long calls and everything is good when these lines are moving together, and then, market's scared, puts are stepping in. And what are actually, interestingly enough, do anyone know what these two major points are? The two major lows, and I believe that's the case for here at the in November. Excuse me. These were the days. The major lows were the day before. The day after option expiration. In other words, the market low came on the Monday after a major options expiration. That's what the December low was in 2018. That's also what the March low was in 2020. Those aren't coincidences, right? Same reason that the Nasdaq popped so strongly on Monday. Puts get closed, that's big fuel, right? That's big upside fuel. One last thing, I snuck this in because vanna is the buzzword of the day. A lot of people like to talk about vanna. And I want to talk about gamma, and we talked about delta and gamma and how those kind of intertwine. And we want to talk about this vanna concept. Excuse me. So vanna is the change in delta of a portfolio for a given change in implied volatility. Now, nothing happens on its own, meaning it's very rare that the market is going to sit and do nothing while volatility, like the VIX, doesn't move, right? The VIX is not going to shoot up or down 10 or 20% without the S&P changing price. It can't. And I say that because the price of options are changing when volatility shifts, and hedging flows are going to move the stock price. So we kept getting a lot of requests about how do we model vanna? How can I see vanna, quote unquote? What's the effect? Well, what you're really asking is how are the deltas going to change if the market moves up and down, right? Because you can't just say, what is implied volatility going to do to the market? Because again, if implied volatility drops, we believe that the market's going to go up. And if implied volatility, i.e. the VIX, spikes, market's probably going to go down. Now, obviously there's times when those correlations break down a little bit, but we're making generalizations here, and that's a pretty good one. So how do you read this chart? What is this telling us? How does this help us trade? At this star, right? So the red line is the assumption of what the long exposure is of an options market maker's portfolio, right? They're generally long calls, short puts. That creates a positive delta position, meaning if you're long calls and short puts, if the market goes up, you're going to make money, right? That's awesome. If the market goes down, you're going to feel the pain. So we talked about delta neutral, right? So what does that mean? So at the red line, that's what we estimate the options market maker's exposure is from their options position. They are likely to have completely hedged out this position. So rather than paying attention to what you see on the y-axis, just think that the portfolio that we're looking at here is delta neutral, meaning there's no directional exposure for the market makers at 38, let's just call it 38.85, right? They're delta neutral. Now, if the market moves up or down, they have to adjust their hedge, right? So if we just adjust for price on its own, meaning we don't touch volatility, as the market goes down to 38.40, 38.50, you can see that the dealer's exposure goes up. That means that they need to short futures because they need to get their futures back to delta neutral, right? If you were to draw a line straight across parallel to the x-axis, you would see, okay, we need to sell, I don't know, 100, 200 futures, whatever it is, to get this number back to neutral. That's the goal, right? Get me delta neutral. Now, if we add implied volatility to the mix, if we spike implied volatility, what happens to that portfolio? Remember, we're short puts if we're market maker. Vol spikes, put options go through the roof. This whole pink shaded area now is the additive effect of implied volatility, right? The exposure is much bigger when you account for implied volatility. Now, our normal gamma models account for volatility. Our normal gamma model already incorporates this information in, and it always has. But if you break out the deltas, it's actually a pretty useful chart because you can see exactly what happens here, right? Vol spikes, they got a short. Now, what's interesting, if we shift to the right side in this case, the exposure goes down. So what does that mean? Well, if they're short options right here, right? They're long option, they're long delta from their options exposure with short futures. Hey, their exposure, their option position actually gets less long. The long exposure decreases a little bit as we move up to 39.20. So if we don't account for volatility, that actually means they could buy back some futures here, right? They don't need to be as short with their hedge because their portfolio is losing a little bit of long exposure. But when you decrease implied volatility, when you drop implied volatility, which is what would happen, right? If the market goes up, VIX goes down. Look at that the long exposure spikes higher. So instead of saying, hey, they have to buy back a little bit, no, they actually probably need to short futures, right? And so this is the resistance as we get into 39.50, as this builds up. So the position is literally we're going to short some futures as the market goes up and short some futures as the market goes down. And then, of course, if we're down at 39.50 and the market comes back up, well, they got to buy all this back. Because just imagine that we're sitting here at 38.50 and they shorted an extra, 10,000 futures to hedge themselves right here, and the VIX just drops for no reason. What happens? They just got to start buying futures back, right? Because their options, their put options are bleeding value because vol's coming down. They're going to have to start buying back futures, and up we go. So, I was thinking about this in looking at, I'll talk about the other chart here in a second, but, I was looking at this chart and you're like, well, what happened at 38.50 today? I mean, 38.50 was a big area of puts. If we look at the VIX, let's bring that up quickly. I mean, I generally tell our subscribers, and they're probably tired of me hearing about it, but I talk about use the VIX as your guide, right? And real options traders, the professional volatility traders are gonna, shake their fist and say you can't do that. But unless you're gonna model implied volatility and watch, a skew in the SPX and things like that all day, the VIX is a great simple way to watch, what the market's doing. So here in blue we have the VIX indicator, right? And you could see that from the start of the day, it just dropped really hard, right? So I shouldn't say the start of the day, excuse me. From midday at the lows, like we peaked up here and VIX, which is the blue line, just collapsed, right? And it just collapsed into the close. And you can make arguments around, which one comes first, S&P move versus VIX. But my point is here, when this is breaking down like this is telling me that put options are getting crushed. And when put options get crushed, I know market makers need to adjust their hedges. And the number one time at which you need to make sure your hedges are square is the 4 o'clock close, right? Because it's the 4 o'clock close, which is going to be measured by all the risk desks everywhere and your custodians and prime brokers and making sure that your stuff is tight, right? So you got to make sure you have your hedges in place and you're good at 4 o'clock. And so when VIX gets blown up all day, right, from this high, that into the end of the day, there's some hedges that have to get bought back. They don't need those hedges anymore, right? And anyone that owned puts in here is starting to cry and run away, right? And if you look at, what's so interesting along with this is I mean, maybe it's just interesting timing, but I wanted to show you guys what's interesting here is if you look at, we like this financial juice here, great service by the way, but right around 10 o'clock, it's like every Fed member there was out, saying, hey, everything's great, Bostic, everybody else. They're talking the market's kind of off the ledge all afternoon, right? And then, look, VIX collapses. Oh, guess what? Everything's probably going to be okay. Close puts, VIX collapses, market rips back higher. It's a cycle, right? And we have called for market weakness, and we see structural reasons for the weakness to take place. And we noted 3850 as first support in the market. And no one can predict all things, right? But you can watch indicators in the market to get an edge, and those are, I think, very simple indicators. Now, before I get too long-winded, I want to just talk about the difference in the Vanna model with Qs here. Notice how slanted this bar is relative to the SPX. Yes, the SPX is slanted, but this is, has a much more of a skew to it. There's a lot bigger of a negative gamma position in QQQ, meaning there's way more puts in Qs than there are SPX. So there's a lot more volatility because of that. And so again, we talked about it on Friday into Monday, dealers got to buy back all these futures, but you can see like there's a huge amount to sell of futures when the market goes down, of maybe not futures, but QQQ or Nasdaq futures, right? And as the market goes up, what's interesting is the volatility increase, right, is still kind of delta neutral. It's kind of flat, right, versus what flat to delta neutral. So they're likely not going to be selling. And if this model's even off just a little bit, they're probably buying some futures back. Now, this doesn't account for, and this is a key point to remember, this does not account for people closing their positions. You can't, you can't know at the start of the day, what people are going to do. If they add puts, the delta hedge, that means more selling flows are going to come into the market. If people close puts or buy calls, that means more buying flows are going to come into the market, right? And we can't account for that at the start of the day. So this is a model locked in time, and you kind of need to make mental adjustments, right? You also have to figure in gamma. This is only looking at delta, right? So what are the gamma levels telling? So at 3950, there's big levels. I know that. I know that the Vanna lines up to say, hey, there's selling flows based on that, on the delta adjustment. We have these big gamma levels at 3950. Great resistance point, right? So you can combine these, and hopefully you all can see how these pieces sort of fit together into a little bit of a puzzle, a market puzzle, so to speak. So with that, we're going to stop as it's 5:30. We're going to take some questions here. We have our awesome team member Julia on the chat here helping us moderate. So I'm going to scroll back up and try to answer a couple questions. I know some people had some questions about this Equity Hub tool that we have. And if there's a stock that someone wants to look at, just pop it in the chat there and we can take a look at that. Babu, yes, we are recording. YouTube Live actually does a great job for that. David Blake, our good buddy, great trader. Tarantino, I thought you had a question there. You tricked me. Same with Mark. Let's see here. So the right index in buying versus selling RE, the dealers. I'm not entirely sure about that, Paul, if you can sort of expand on that question. William Klein, great question. So how often market makers delta hedge? Is it constant? So anytime you trade a lot, as you all know, there's transaction costs, there's commissions, and then there's also paying spread, right? And so I think that market makers in general want to hedge as little as possible. And so the times that, that is, I think, kind of guaranteed, nothing is guaranteed in this business, right? But on the open and on the close are obviously the two biggest areas of hedging. And then a lot of think is just based on price, right? If price moves enough and they need to hedge, if enough trading has taken place, they'll make some adjustments. So in a sense, it's constant, but it's a waste to sort of hedge too much, right? Those are transaction costs that don't need to be incurred. And I also think that in certain single stocks, they may lean certain ways, right? If GameStop is going against you, you can maybe hedge your book in a certain way to sort of lean and accept a little more directional exposure there in certain circumstances. Browser Sync, is there an Options Gamma 101 webinar? How did you apply this? I hope I answered some of those questions today. We do have a FAQ on our website that kind of walks everyone through all the basics, that fills in a little bit more of this chat. Right, Peter Stewart, they defend positions. Good point. You can absolutely, Loki Lobo, I hope I pronounced that right. You can absolutely have a gamma squeeze on the downtrend. So that's a good point here. So there's this concept of what we call a gamma trap, which was kind of what people called the gamma squeeze before the squeeze became popular. So what's a gamma? Let's just call it a trap. Well, when vol spikes, people get scared. They buy puts. As we talked about, when people buy puts, dealers are short more puts. They got to short more futures, which sends the market down. When the market goes down, people get scared. They buy more puts. Vol goes higher. Dealers sell more shares. So it's a reflexive. Soros coined this phrase of reflexivity, which you can look up, but basically it's a feedback loop, right? And you can get stuck in that feedback loop, which is one of the reasons that when the market is under hedge, it's a little concerning, right? Because everyone gets actually scared and goes to hedge at the same time. This feedback loop kicks in where put buying drives higher implied volatility, which drives dealers to short more, and we just get a feedback cycle. So that is what we call a gamma trap, or you can just call it a gamma squeeze. It's the same thing, right? With what happened with GameStop or any of these other squeezes. Higher stock goes up. Long calls cause dealers to have to buy more stock. People want to jump on the bandwagon and make money, right? And you get this reflexive sort of feedback loop. When a position is open, how do you know which side the dealer is on? So very good question. There's some tools out there now that you can monitor which side the trade took place on. Did someone buy the option or sell the option? Open interest itself is not released until midnight. There's some people who are trying to track open interest, and I think in single stocks there's some interesting opportunities there. I think there's opportunity intraday watching which way options are trading. If people are buying a lot of calls or buying a lot of puts and they keep hitting the bid, you can see that. That works okay in spiders. SPX, a lot of volume takes place in the mid-market, so you also don't know which side those trades are on. There seems to be this drive in this industry to kind of try to call things to the tick, right? And I think that makes models kind of fragile. I mean, what we talked about here, I think provides a lot of edge, right? It's explainable. You know which way flows are leaning. There's big open interest levels. And I use the word dexterity a lot because, there's so many different pieces in a market, obviously. Options is a huge, let's just talk about options flows, right? I can't think of another entity that would have more active hedging and trade more than a market maker, options market maker or stock market maker, right? They have to be in the market all day long every day. Prices are moving all day long every day. They got to keep hedging. And so they have literally unlimited firepower, right? Because they're constantly buying and selling back. Now, if you're a hedge fund or a 401k, administrator like a Barclays or Vanguard, you got to buy some stock at the close and you're done, right? You buy your 20 futures and wait till it hits your price or whatever it's going to happen, right? But the market makers are there all day long, day in, day out. So yes, those flows, the hedging flows can get overwhelmed, right? And that's, like anything else. Why did we break 39.50 this time but not this other time? I don't know who was buying in here. Someone great was buying, but once they stopped buying, what happened? We pulled right back down into this big hedging zone. So my point is that you can figure out which way people are leaning, right? But price gets drawn to these big open interest zones. And it's something that happens kind of over and over again. And your edge comes when you know which way people are leaning. When the market is dropping, when the market is dropping, we know that puts are making money, right? And so dealers are short puts, they need to hedge. But what happens if you're short a put and the market just dropped 2%? What are you going to do? You're going to close that put, right? And that's a negative flow. That when you're short a put and you close it, that means the dealer can unwind their hedge, which creates selling flow. So in other words, you can find these big times, where I think there's good alpha in there, right? And there's really great edge. I could sit here and try to say today's going to pin 39.41 because I saw X amount of hedging today. The number of people hitting the bid today in options was this and selling was this, and it's like you get too granular, and I think that invites again fragility to use use a term. Hopefully that wasn't too much of a tangent. Ahmad, I'm not sure which chart you're mentioning, but let me know, buddy. Vanna model, Peter Stewart. I hope I made your afternoon there. It is going to be recorded. Is this gamma pinning? Yeah, I mean, you know, look, you look at this big number, you look what the market did today. It's a zone, right? And the closer we get to options expiration, which is another good point, you know, Monday, Wednesday, Friday, there's these big options expirations, and I think you can see pins form there. Good point here to talk about something else. The hierarchy, I think, of hedging flows. Obviously, market makers have a book they need to hedge, right? But then whatever is going to expire today is probably the most important flow, right? It's the highest gamma flow. But if I am let's say that the bulk of new positions open today, right, for today's expiration are at 39.25. Many of you are familiar with the Max Payne sort of idea, right? That the market's going to go to 39.25 because that's where the most people lose the most money or whatever it may be. I think that there's something to that, right? So a lot of times, if you look at how much open interest is active in today's expiration on the Monday, Wednesday, Friday, you know, you can kind of get a sense of where the market's going to move in the very short term, right, in that afternoon. And then you need to take that in context of what is the overall market position. But hopefully you kind of understand what I'm getting at, right? When you have same day expiration, you know, to push the market up or down a few ticks to get a bunch of options to expire. And then, you know, you can worry about whatever your April position is later, right? And I mean, I'm making a generalization and oversimplification here, but hopefully that makes some sense. Challenger, Ferrari, are these based on open interest? The calculations, the fundamental basis are on open interest, yes. And there is no open interest feed available until midnight. And you need to have some special code to kind of make sure that you're getting the most up-to-date open interest. So, you know, make sure that's the case. For instance, a lot of times when you look at your brokerage platform, they're showing you stale open interest, right? And so you want to make sure you're getting the most up-to-date open interest. A discussion forum in the Equity Hub would be helpful. So we have a Slack channel. I don't know how many of you are subscribers. If you subscribe, you get free access to that Slack channel. There's a lot of discussion there on Equity Hub, which I think is kind of beyond the scope of what we're going to talk about today. Using SG with futures. So Zena asked, building on, can you walk us through using SG with futures, please? And Attila asks, I'm trading NQ, what values can I mark in my chart and how to react when price hits those levels? Okay, so I guess let's just look at a real-time chart for today and just talk about, you know, we showed this chart before of volatility, and we can show everyone kind of our morning note, right, and just see what the levels look like and how that played out. And then we can set up something on Equity Hub later on to go over some of that. So we got another about 15 minutes here. We can just talk about what we saw today. Give me a second here. I want to pull up this morning's note. Sorry, everybody. I know silence is not good on a YouTube live. All right. Here we go. So this is the morning note, and we give our breakdown and our analysis, right? And we mentioned at the top what the key initial support and resistance lines are, and this is the highlighted message. So futures are breaking down at the time we sent this out. The initial support was 3850 and 3900 resistance. So why did we pick those levels? Those are based off of big open interest, right? And so we have some other ways to show this, but if you look at these levels in here, so we have spiders and SPX, the biggest open interest areas, so 3950, 3900, 3895, obviously. And then we have these combo strike areas as well. So 3860 was the one that we saw. We know that 385 in spiders was a big area. And then the other one that came up today that was an important level was 310 in QQQ. And obviously, you know, there's a lot of overlap between constituents in the Nasdaq and the S&P. And so, you know, these were essentially the levels that we were looking at today. And based on the amount of game in the market, again, we mentioned that it was a 47-point range is what we were looking at to go. And the key, again, that we said today, watch the VIX, right? because you can guess or feel like the market's going to go short. But I'll tell you right now, if the VIX is dropping, especially when we've made a new low in the market, then I likely don't want to be short anymore, right? So I'm just going to push this pop-up right here. This pop-up is a nice way to kind of look at the levels on the day. So, look at how the market traded versus these levels. And, you can see as we opened, and this is the spider chart here, this in orange, we came down to this 384, 385 level, right? And I guess I should change this to the SPX. It'll make it a little bit more relevant. Well, you guys are watching how poor I am at loading in things into TradingView. Hope you are laughing at me as much as I am. So do the new price scale. Okay, so here's our kind of low, right? 3860 is what we highlighted based on this pop-up window. So 3860 is the level, right? And that was, we mentioned 3850 in the morning report. Market breaks down pretty sharply to that level, and it holds there, right? This is the big gamma area, 3860 that's highlighted. And so what do we then anticipate? Well, VIX made a high, right? And at this point, the VIX stalls out. So there's two things that happen, and these synergies happen a lot. You hit a big options gamma level. This actually updated for tonight's level, so that's why they're showing different. So if we flip back to that note, we'll see the 3860 in the chart. Sorry for that mix up there. So, the 3860 is right here, right? And it's called a combo strike because we combine the total open interest in the spiders and the S&P SPX big contracts. So again, 3860, right? We hit that level and the market stalls there and it pauses. And whether it's Fed statements coming out or whatever the reason is, who knows? Puts getting closed maybe, whatever. The VIX stalls there, right? So it's at this point I say, okay, we're at a major gamma level 3860 and VIX is stalling. So the odds of when the VIX starts to break down here of us kind of starting to revisit as we found support starts to dwindle, right? And at some point you got to say the VIX has broken, right? The VIX is trending down. More Fed speakers are coming out, whatever the news may be, whatever that feeling is, whatever the momentum is, you could tell that the VIX has now decided to change trend and we immediately reverse, right? And puts are getting closed. My good buddy Jonathan told me, you could see the liquidity that turned up at 3860, which to him indicated that maybe a bunch of options were getting closed. And there's tools out there you can look at the tape, and see options trading. The point is that when a VIX high or low corresponds with a big gamma level, you can see these changes often, right? And so as long as this VIX is trending lower, and you saw it again into the close, we know that 3900 is this big area of interest, right? It's this giant, vortex of gamma sitting there, and the VIX is breaking down, and the huge vortex is, of gamma is sitting there, and you can just picture puts getting closed and dealers saying, I got to hedge this thing up into, the 3900 big gamma area, right? And so this is, again, I'm taking a lot of generalizations, and I don't know exactly how you all like to trade, but when I look at the market and just from a 30,000 foot view, this is what I'm watching for, right? These VIX reversals corresponding with the big gamma areas, and then into the close, as I mentioned before, we know that dealers need to hedge. Anytime you get a big move like this, big VIX drop or big VIX spike, you can kind of infer a little bit like, oh, the market makers, now that VIX dropped real hard, they probably have some shorts to cover, right? Or, hey, VIX spiked like crazy into the close. They may have some shorts, that they need to add, right? And that can oftentimes give you the indication of pressure, as we shift towards the close. So hopefully that gives just quite an idea of, what it is that we're looking at. Trader Lou, the Slack is for every subscriber. You don't have to have the Equity Hub only. Originally, we launched it just for the Equity Hub only, but we do have a lot of guys talking S&P and talking everything else in there. So please join that. If you need help joining that, just hit us up at info@spotgamma.com. New features. We have a whole bunch of new features coming out. We are launching something with Bookmap, which we are super excited about. Bookmap's a great futures trading platform for those of you in the futures trading space. Actually, they actually have good equity trading tools as well. And we are working on something with Vanna, making that a little bit nicer and accessible for everybody. And then I think 1 or 2 more sort of secret things to launch. So we're super pumped, and April is going to be a rollout of a lot of great stuff. The pop-up in place of this, if you go to the members page, so you just go to members and then you go to portal, and then you have the 2 pop-ups. You have SPX and Nasdaq. I need to get IWM up there. I know a lot of people are looking for that. In an alerts feature, that is something that is on the board actually. IWM implications for credit spread sellers. Yeah, so IWM has a picture that's really a lot like Nasdaq, in that there's just a lot of shorts. But the thing with Russell is that there tends to be a lot of puts in IWMs, and I don't know if that's because people have been historically selling value. I mean, the whole value rotation thing is a little bit over my head, but you know, when you see how much this is all negative gamma, right? And positive gamma doesn't sink in until 235, but this chart is usually full of puts. So, and that goes kind of for Russell in general too. I talk about IWM and Qs just as a point of reference because generally the open interest in Nasdaq and Russell is like a fraction of IWM and QQQ. So I think that actually the Qs and the IWMs, excuse me, wag the dog, so to speak. So, you know, IWM is a similar situation to Qs where you just get, this is all negative gamma, right? People are long puts. And so, you know, if you can figure out where good bottoms are, you know, for credit spread selling, you know, that makes a lot of sense. And I also think as soon as you get into a positive gamma territory, you know, it's a good area to look at selling call spreads, because generally this is so weighted negative in terms of its gamma position. And when I say, like, if you can figure out where the gamma might start to fizzle out, it's implied where the trough appears here, right? A lot of times it aligns with this thing called the put wall, but really you get this trough, and this is kind of where the rate of change of gamma, or how much, you know, hedge adjustments need to be made, starts to kind of fizzle out, as you can see under 210, and that could be an area where, you know, the sell-off might stall. I believe I can bring up the vanna chart for IWM as well, just show you guys that real quick. You can see it just looks a lot like Qs. And then after that, we could take one more quick question, and then we will call it a night so everyone can go and enjoy their night, day, whatever it may be. So you can see here, again, much like the Q, you know, chart, almost kind of identical actually, in that, you know, even on a big rally, the dealers are just going to most likely have to buy stock back, right? They're going to make to buy IWMs back. So these can be tricky areas to try to sell credit spread. They're the juiciest times to sell credit spreads, right? Because vol's high and things are moving, but that volatility potential is really there. And you can see, particularly on the upside, you know, you can get run over real quick. You know, if you sell, call it 217, and this thing can run you over kind of in a heartbeat. So, okay, I'll take one more question. It's coming to search functionality in the equity hub. 305. I don't think I'm saying that right, but 100%. Loud and clear, we hear you. Tools for accessing the tape. There are a couple of live options feeds out there that you can look, and the names are escaping me off the top of my head, but I think if you just search for a flow algo, I think is called one, or black box docs, I think is the other one. I don't know if we froze or not. PX, Mystic, PX is just price. That's the underlying price. George Linus, book map on the timestamp. Yeah, so we can add time to the stamp. There's a date on that feed. Pigs, thanks for mentioning that. And please comment on size versus open interest. I'm not sure what you mean there, Michael, if you could just state that. And then we'll take one more question here if there's anyone in here. Check liquidity on slide 11. All right, Sylvia, thank you. Oh, how do we measure the expected daily range in a product using options? So P-Trader, that's a function of how much gamma is in the marketplace and a whole bunch of historical data. We believe that those options flows, you know, control volatility in the market or have a great deal of impact on those flows. And so you can essentially look at, some basic math, figuring out how much the implied move in the market is on a 1 standard deviation basis, based on all that historical data. So we're not using options. We're using estimated, hedges. Really is what it says. So, all right, cool. We're gonna end it there. We really appreciate Jacques. The bookmap stuff is supposed to launch in beta on April 1st. If you're interested in being a beta member, beta tester, shoot us an email, info@spotgamma.com. I can't reveal what it is yet, but it's really cool. So I will just say that. So anyways, enjoy the rest of your night. I really appreciate everyone taking the time. This will be uploaded to our video channel in public for all to use. And if you have any questions, @SpotGamma on Twitter or info@spotgamma.com, where our awesome team member Julia will be more than happy to answer your question. Of course, me too. Okay, thanks everybody. Night.